Hi guys, Will here, and in this video I want to share with you how to trade like Goldman Sachs along with the principles behind their strategy. And just very quickly, before we dive in today, if you are struggling with your trading or you'd like to know more about how mechanical edges are traded, I've actually put together a free video course for you that will map out and explain everything in detail, along with walking you through exactly how mechanical rules actually work. If you'd like to watch that after this video, I'll pop a link to that in the description and you can click through and watch that straight away. Hi guys, Will here for WB Trading and welcome back. If you are new to the channel, please do hit that subscribe button and tap the bell icon so that you don't miss any of the free content that we share with the trading community here on YouTube. Anyway, let's get straight into today's video. Now, if you were to Google search who is the best risk manager on Wall Street, you'll get the answer Goldman Sachs. So why is this so important and how should you be managing your risk like Goldman Sachs? Let's start with the concept of hedging. Okay. So if we rewind back to the 2008 global financial crisis, Goldman Sachs survived largely because their traders actually had the foresight to sell the market along with hedging their positions, keeping them not only alive but thriving during a market crash that actually wiped many other market participants completely out. In other words, they took a bet and yet also protected their downside by assigning a portion of their risk to the other side of their own trade. This is an example of hedging in action. Now, you may have heard the phrase hedge your bets, right? Hedging is an element of risk management whereby a trader might largely, let's say, sell the market, but will also buy a smaller portion of the market as one example, so that if the trade does go wrong, they aren't wiped out entirely. Hedging simply means to protect, really. Now, to survive in the game of trading for the long term, a trader must first learn to protect their most valuable asset, their capital. Further to a previous video here on the channel where we spoke about currency correlation, by trading a longer term strategy, such as let's say our higher time frame bias bar strategy for example, a trader can successfully hedge to avoid correlation by trading alternate markets at the same time using different levels of risk. Not all strategies allow for this, but ours do. I'd also add that when trading various currencies that are either negatively correlated or positively correlated, this knowledge actually removes the anxiety and the need to monitor the markets frequently, because you know you're avoiding trading, let's say, two markets containing the same base currency, thus overexposing yourself to the same market more than once. I actually refer to this somewhat inside our Platinum program in the video See the Years and You'll Be Profitable, where I mentioned that trading is a long-term business and there are two key ingredients when it comes to success. Number one, having an edge, and number two, the reason why we're here today, managing risk. Next, let's discuss the 1% rule. Okay, another popular method of managing risk is what we call the 1% rule. Now, Investopedia defined the 1% rule as a rule in which a trader risks no more than 1% of their available capital on any one single trade. To apply the 1% rule, a trader must first determine their available capital, taking into account any future fees or commissions that may arise from trading, and with that, calculate 1% of this, and then place this within your stop loss when taking a trade. By doing this, you will never ever blow up your trading account, unless of course you make a major mistake of your own. And yes, look, the growth of your account may be slightly slower by keeping risk managed, but remember, trading is a business. It's a long-term endeavor. And here at WB Trading, we want you to trade for 30, 40, 50 years plus, not just, let's say, 1 or 2 months. Remember, as our client Azri Azahari says, trading is a get-rich-slow scheme. And by trading with edge over the long term, you will one day be, very rich due to that patience. Next, let's discuss treating your trading as a business. So let's now explore the concept of the job pay
mentality. Okay, many of the traders that we work with tell us that they want to replace their income via their trading. They want to quit their job like we have ourselves, and they want to escape the commute, spend more time with their loved ones, and so on, which is a really great ambition to have, and one I think everyone should achieve, and that I'm honoured really to be able to help people achieve too. But the major mistake that a lot of traders make is aiming to achieve, let's say, X per week, every week for life. And I can understand the thought process here because, well, let me explain. Most people in the world have had a job in which they work, let's say, X hours, and they get paid Y, right? For many years of their life, they sell their time in exchange for money that is tied to that time, i.e. They're paid X per hour. Trading, however, doesn't work this way. 1 month you might make, let's say, $1,000, and the next you might make, let's say, $7,000, and the next you might take a minus $600 loss, and the next you might break even. This is difficult for many newer traders to really get used to, and whilst over the long term your strategy may average, let's say, 9% per month, the word here is average, not provide for you every month. Now, the great thing about trading is that there's absolutely no ceiling on your earning potential. All it comes down to, more or less, is strategy and account size, right? And coming back to my point here, trading is a business, a long-term venture. It's not a job where you exchange some time and get some money. It just doesn't work like that. You can make really a near infinite amount of money in trading. And for you to be successful, you have to scrap that job pay mentality, okay? You have to think like a business owner. And why do I say that? Why do I say scrap the job pay mentality? Because this mentality is detrimental to success, because it can lead to a trader snatching at small profits and trying to achieve that number that's in their head, along with holding on to losses in, well, the blind hope that the market will turn around and come good. Believe me, it rarely ends well when in this situation. I've been there earlier in my career, and I regularly hear from people who've completely wiped their accounts by going this route. When a trader does this, they're no longer in control. It's that simple. The market is in control and they're finished. In fact, that's why here at WB Trading, we introduced our mindset and understanding section within our program to really drill down on this concept, to help our clients realize that, yes, there will be up months, but also down months, so that they feel reassured, really, and don't panic and go crazy when they have 1 or 2 losses or a down week, for example. We've had people actually request a refund in the past because they took 1 single loss on the first trade that they ever took, because they're so attached to that need to make money straight away, instantly. And again, that's that job pay mentality driven into us by the education system that lines us up to live a life of robotic, mindless work. Don't fall into that trap. Don't come into trading looking for a fixed income like that you would get from a job, and yet wanting all the benefits of trading, like removing the commute, removing the need to report to a boss, and so on. Life just doesn't work that way, unfortunately. If you want freedom as a profitable trader, you accept the ups and the downs of having a much bigger income, yet one that fluctuates. And if you can't accept that, well, the only choice really is to remain a wage slave robot, isn't it? With your income decided on not by you, but on your boss. And, well, I'll leave that decision to you. Now, to conclude, these are the questions that you need to answer before you finalize your next step as a trader. Firstly, do you have an edge over the market, along with clear rules to follow that allow you to capitalize on that edge? Next, what's your win rate over a sample of, let's say, a 2-quarter period? And also, what is the reward to risk ratio that you're actually comfortable with? And finally, what is the maximum amount of money you're willing to lose per trade? Now, as you can see, to answer points 2 and 3, a trader needs to be patient and actually follow their rules to a T for at least 6 months, 2 quarters, okay? And at the same time, keep a trade journal to document the entire experience. A lot of successful traders that we mentor do that, keep a detailed record of their trade journal, and they utilize our one-to-one coaching calls to keep themselves accountable, going through all 4 points above in detail with their trading coach every single month. And by doing so, they not only improve their trading performance, they also gain that all-important insight on how to improve their risk management and their trading psychology too. And with that, the results always come. Anyway, thank you for tuning in, and I'll see you next time.